If you shift gears but you stay in the central theme of central banks and you go into the emerging world, if you take a look at China, for example, China's issues are very different. They don't have the debt problems. What they have more of is issues of how do we continue to grow the economy, put a lot of the peasant farmers into more of an industrialized worker environment, but yet control inflation. So as a result, their policies have been more tightening. And as a result of that, you can see disappointments around the economy in China. And you could shift gears and go to, say, India, where their central bank has had a lot more difficulty. In our last market update for the third quarter of 2013, we talked about capital market rotations. And India was probably the most affected by a capital market rotation this past year, where their central bank was trying to stabilize their currency, but because of interpretation of what the Fed was going to do, there was a lot of money exiting India and coming to the United States, which caused the Indian rupee to drop a lot, which creates more inflation when they're trying to purchase stuff. So kind of interesting when you think about the developed world versus emerging markets experiencing different things, but the central banks are very involved. When you go to what I think of as real emerging markets now, places like Turkey, Indonesia, that's where the central banks really are so small that they don't have the ability to have monetary policy that's strong enough to affect other countries and other regions' monetary policy affecting them. So it's been fascinating to watch the problems in the true smaller emerging markets. When I transfer from economies to financial markets, pretty fascinating in that the United States led the charge when you take a look at how the equity markets did. A distant second would be developed world international stocks, and then a distant third would be domestic high yield bonds. All three categories did very well. If you take a look at the areas that disappointed the most, without a doubt gold would be the largest disappointment. I think most people are surprised in the backdrop of how people perceive how difficult times still are, that the safe harbor assets dropped and plummeted, and no one really knows, has the bottom been hit or is it going to continue to drop? Some other areas of disappointment financial market wise would be emerging market bonds, also referred to as emerging market debt, and municipal bonds domestically, surprisingly enough, but with some of the concerns that sort of flooded the market as a result of Detroit's bankruptcy, concerns around Puerto Rico, and then just some major states like Illinois, California having systemic problems with pensions and whatnot. Some categories that necessarily didn't disappoint but certainly didn't do anything positive, so we'll just call them as neutral, would be short-term bonds domestically, as well as things like publicly traded real estate. An area that probably surprised people the most, because it really wasn't an asset class people knew much about, which is this all market or tactical, basically industry analysts and portfolio managers that do trend following. That was an area that surprisingly did very negative as well. As I transition from central banks to different countries and their economies, you could summarize it by saying that even with the amount of stimulus that's coming from central banks, the economies across the world are all growing at lower levels than what one would hope. For example, the United States has consistently underperformed compared to what the Federal Reserve was projecting. That said, it's still growing at a positive number, call it around 2%, which when you take a look historically, that's not a bad rate to grow at, especially when you take a look at the size of the sheer size of the economy itself. When you then take a look at Europe, you could say that much of Europe is in a recession. Not all. The northern European countries are doing better than the southern European countries. Inside of the southern European countries, though, you really have some areas that have depression-like settings when it comes to unemployment. Spain is a great example of that. When you shift gears and you go to, say, Japan, Japan's in a unique situation in that the monetary policy there really is providing some great stimulus. They're having the best economic performance that they've experienced in decades. That said, it's still under what the United States is growing at. And then when you look at the emerging world, China is without a doubt the second largest economy in the world and doing quite well. It's experiencing mid to middle single-digit returns on its GDP, but that still disappoints compared to what they were expecting. You look at India, India has some problems of its own, but the real problems lie in what I'll classify are the small emerging markets, places like Bangladesh, Indonesia, and Turkey. Those countries are so small in their economy that they're fragile when it comes to capital market rotations, that they're having a difficult time absorbing. So if I were going to summarize 2013, I would summarize it by saying that a grand experiment's been going on. Central banks have been adding monetary policy that's been very stimulant, and the net effect of that has been risky assets have done very well. The other effect of it is that interest rates have begun to rise, and investments that are negatively affected by rising interest rates have been hurt. At this point, I'd like to transfer over to Rich to talk a little bit about energy.